Welcome to GRE. I'm your host, Keith Weinhold, fielding your listener questions on changes to realtor fees, your down payment strategy, and how the new 100% bonus tax depreciation really works, then staggering inflation statistics that motivate you to invest in real assets. Today on Get Rich Education.
Since 2014, the powerful Get Rich Education podcast has created more passive income for people than nearly any other show in the world. This show teaches you how to earn strong returns from passive real estate investing in the best markets without losing your time being a flipper or landlord. Show host Keith Weinhold writes for both Forbes and Rich Dad Advisors and delivers a new show every week. Since 2014, there's been millions of listener downloads in 188 world nations. He has A-list show guests include top-selling personal finance author Robert Kiyosaki. Get Rich Education can be heard on every podcast platform, plus it has its own dedicated Apple and Android listener phone apps. Build wealth on the go with the Get Rich Education podcast. Sign up now for the Get Rich Education podcast or visit GetRichEducation.com.
You're listening to the show that has created more financial freedom than nearly any show in the world. This is Get Rich Education.
Welcome to GRE, from Athens, Pennsylvania to Athens, Georgia to Athens, Greece, and with listeners across 188 world nations, you are listening to Get Rich Education. I'm your host, Keith Weinhold. Yeah, you and I are back together for a 566th Wealth Building Week. This is not where you learn how to create wealth through careful sports wagering at DraftKings. We also don't try to do everything like Walmart. We talk about investing actually pretty aggressively, yet reasonably and responsibly at the same time. Usually those attributes are opposites, but because we are leveraging the most proven wealth-building vehicle of all time, real estate, where you don't have to be the landlord, you don't need to get deeply hands-on with house flipping, and you don't need to own property in your local market, though you could. We are not day trading, we are decade trading. There's not a get-rich-quick element here at GRE because that doesn't work. We're owning mostly long-term rental properties, bringing the financially free beats debt-free approach, and cognizant that compound leverage trumps compound interest. And from the day you start focusing on this, you can retire in 5 to 10 years, and you can take it as far as you want, because unlike many professional sports, the sport of real estate investing doesn't have any salary cap at all. I'm starting off with 3 of your listener questions today. You write into the show with your questions, and when I've got a few that I think could help a lot of you, I answer them here. And as usual, I start with the more introductory question, and then I proceed to the more advanced. The first one comes from Sherry in Sellersburg, Indiana. I know where that is. It's just across the river and to the north of Louisville, Kentucky. Sherry asks, when I go to sell my duplex, how have last year's changes in realtor fees affected my sale costs? Yeah, thanks for the question, Sherry. And a lot of people still wonder about this. First, and I'm being a little technical here, but this benefits other listeners, Sherry, is that a realtor means that they are a member of the NAR, the National Association of Realtors. So not all people that you enlist to help you market and sell your property are realtors, because not all agents belong to the NAR. In fact, the best catch-all term for this person is not an agent. Depending on the state you're doing business in, it's probably licensee, someone licensed to act as your professional intermediary in a real estate transaction. And by the way, the name of an NAR member is a realtor. It is not pronounced real-utter. It's realtor, like doctor and lawyer. You wouldn't call a doctor a docator. 2 syllables, realtor. But to get to the crux of your question, Sherry, the changes to realtor compensation took effect almost exactly a year ago. It was last August. and it has less of an effect on the industry than many thought. I stated last year that it likely wouldn't affect things much, especially here on the investor side, and it really hasn't. The simplified version is that the old landscape was that when you used to list a property for sale, the listing agent charged you a fee, traditionally 6%. They offered half of that to any cooperating broker that brought the buyer to you. That was simple, and that worked for decades. That changed 1 year ago. Now, when any realtor or really licensee, when they work with you now, they simply contract with you for their fee only, like 3%. As a seller of the property, you no longer have an obligation to pay for the buyer's side agent as well, like you used to. But when you sign a listing agreement, you can indicate that you may be willing to concede and give an allowance to the buyer when they engage a licensee on their side to help them purchase your property. So, Sherry, your voluntary contribution to the buyer side is negotiable, and it's part of the offer that the buyer presents to you now. That's what you'll see as the seller and what you should expect. As a buyer, the new landscape is that buyers negotiate a personal service agreement up front with their licensee. Their service isn't free. I mean, these people can't work for free. And the buyer side licensee acknowledges that they will try to negotiate to get the seller to pay that fee. So, Sherry, in reality, that's still what often happens. The seller still pays that fee in the end. The reason why is that not only is this traditional, but buyers cannot normally afford to pay for their own representation on top of their down payment and closing costs. They're often spread pretty thin already. But sellers can typically afford it. They have the upper hand financially in the form of equity in the property. And here, when you're buying properties at GRE Marketplace, you don't have to pay any of those fees. We use a direct model without a licensee. So that's sort of the short version of the change and why. I hope that helps, Sherry. It's a good question. Even licensees are struggling with the new rules. The next question comes from Jezebel in Yonkers, New York. Jezebel asks, what is the ideal percent down payment that I should make on a rental property? I'm trying to figure out the trade-off between debt level, cash flow, leverage, and risk. I'm still trying to get past the mindset that paid off property is best. All right, that's Jezebel's question. And Jezebel, the short answer is that you want to make the smallest down payment possible while avoiding over leverage. Over leverage meaning that your monthly payments are so big that you struggle to make them. Now, many investors that buy rental property, they're going to make a 20% down payment on a conventional loan for a single family rental. At last check, on duplexes and up, the down payment has to be at least 25%. Now, you can make a down payment as low as 15%, at least on a single family rental, although you would then be subject to an extra fee, a PMI premium. Now, why would one do such a thing? For the leverage. Because leverage is almost 7-to-1 at 15% down, but you've got to balance that with a PMI premium, run the numbers, and see what works for you. Now, since you can make just a 20% down payment on a single family rental, conversely, why would you put 25% down? Your leverage position would slide from 5-to-1 down to 4-to-1. We can often get a slightly lower interest rate if you put 25% down. But when you run the numbers, you'll find that it's often better to maintain strong leverage and only put 20% down. Now, Jezebel, as soon as you start putting 30% down on a property, that is questionable at 30% or more, because at that point, you really have to start asking why. The rate of return from home equity is always zero. It actually makes your risk go up, like I've discussed extensively before. With 30% down, your leverage ratio has been cut to 3.3. Now, maybe the answer could be that 30% down is what it takes to produce positive cash flow, but putting 30% or more down is clearly not ideal. Think about how good we've got it as real estate investors here. For example, imagine that you're attracted to a dividend paying stock because it pays a 4% yield. Unless you're borrowing on margin, you would need to make a 100% down payment to get that 4% cash on cash return from a dividend paying stock. 100% sunk into this, which isn't even a down payment anymore. That's just an outright free and clear stock purchase. Well, instead, in real estate, when you realize that property prices rise or fall in value regardless of how much equity is in a property, you don't have an incremental increase in your equity growth. It's a quantum leap. And here's what I mean, Jezebel. Say you're investing $100K in real estate. That's how much you're going to put into it, and it appreciates at 5%. All right, there are two scenarios with that. Scenario A, you put that 100% down into just one 500K property, well, then you've got just a 25K gain after a year. Instead, with scenario B, you put 20% down on five 500K properties, then you've got a 25K gain after a year, not just 5K. Said another way, more powerfully, scenario A, you only got a 5% return on one property. In scenario B, you got a 25% return on all of 5 properties. Wow! That's why the leverage light bulb, when that goes off, that is an incredible flex that you've got. That's why I say it is not an incremental gain in your wealth. It is a quantum leap. So I hope that some of those considerations really help temper your strategy there, Jezebel. That really helps you see how financially free beats debt free and exposes the opportunity cost of a paid off property. Thanks for the question. The next question comes from Ed, and he is a personal friend of mine. So he submitted this question by text message to me, but I wanted to address his question here because I've had other people in my friend group ask me about this. It's about bonus depreciation, what it is. It's about bonus depreciation, what it is and how it works. And what's interesting here is that even those that aren't active real estate investors have been asking me about bonus depreciation. This was part of Trump's OBBBA, the One Big Beautiful Bill Act that was signed into law back on the 4th of July. And I told you about that last month, but because of all the questions about it and the lack of clarity around people's understanding of bonus depreciation, although it gets a little busy, let me give you a real-world example with numbers on how bonus depreciation really works and how you can put tens of thousands of dollars in your pocket with it the next time you file your taxes. And by the way, my friend Ed that asked this question is a cargo pilot, so he is probably the most well-traveled friend that I have. Yeah, through our chats and on social media, I often see that he's in China or Vietnam or a bunch of other places, but he lives in the U.S. In fact, bonus depreciation is encouraging more people that haven't even been real estate investors previously to newly invest in real estate because it is for properties acquired January 20th, 2025 or later, Trump's inauguration day for his second term or later. And I expect this to be effective for at least 4 years from that date. I think I mentioned that part to you a few weeks ago. All right, the property has got to be newly placed in service, not something that you bought, say, 5 years ago. Bonus depreciation does not apply to primary residences. We're talking about rental property, although it does apply to more than just rental property because it can apply to property used in a business like equipment, machinery, and furniture. But within rental property, it applies to certain components of the real estate, not the building itself. That is on a regular depreciation schedule. and not the bare land. Land cannot be tax depreciated at all, neither through regular depreciation or bonus depreciation. You probably already know that a residential building itself can be depreciated over 27 and a half years. That works out to 3.6% of the value each year that can be depreciated or written off on your taxes. All right, well, what if there were portions of your building that you could write off faster, like over just 5 years, meaning 20% of their value each year? You can. And others over 7 years, meaning 14% of their value each year? You can. And there's 15-year items as well. All right, so what if instead of all that, you could take those 5, 7, and 15-year components and just write them all off in the first year of ownership so that you didn't even have to wait the 5, 7, and 15 years? You can. You can write them all off in year one of your ownership of the property, and that is what 100% bonus depreciation is right there. That is in addition to writing off the main building over 27 and a half years. All right, with that understanding generally, let me break this down in more detail, use an example, and that will also help reinforce what I just taught you. The components of rental property that bonus depreciation applies to include the stuff that wears out faster than the building, and they are indoor items, appliances, flooring, and cabinetry. At times, it can include HVAC systems. All right, that is written off in 5 to 7 years. And then outdoor items known as land improvements. That includes fences, parking lots, and landscaping. They're typically written off over 15 years. All right, let's look at a real-world example on how this can benefit you. You can use bonus depreciation on single-family rentals, duplexes, fourplexes, and larger buildings. Let's use an example of an apartment building that you purchase for $1.2 million. We'll say the land value is $200K. That is not depreciable. So the building, the depreciable asset, has a value of $1 million. You must have performed what is called a cost segregation study in order to break down that $1 million building into those erstwhile faster depreciating components. And no, you cannot do the cost seg study yourself. You need to pay a few $1,000s to hire a cost segregation engineer to do this study. All right, let's look at the cost seg breakdown, the result of what he or she finds for you. Let's say the personal property, that's worth $150K. Its recovery period is 5 to 7 years, and yes, it is eligible for bonus depreciation. Then you have the land improvements, say that's another $50K over 15 years for a recovery period, and yes, it is bonus depreciation eligible. And then finally, you have the structure or the building worth $800K. It has a recovery period of 27 and a half years. No, it is not eligible for bonus depreciation, just the regular type. All right, well, let me define more of this personal property for you here, these 5 or 7 year assets. These are what are eligible for 100% bonus depreciation in qualifying years. So we're looking inside the units, appliances like refrigerators, ovens, dishwashers, microwaves, washers and dryers. Also flooring, carpet, vinyl, and removable floating floors, not typically hardwood or tile, cabinetry and countertops in some cases, especially if they're not load-bearing, window treatments like blinds, drapes, and curtain rods, ceiling fans and light fixtures, they've got to be detached from the structure, and furniture if it's a furnished rental, like perhaps a midterm rental or short-term rental. So we're talking about things like beds, couches, and chairs. And then in common areas, this 5 to 7 year personal property includes fitness equipment in the gym, leasing office computers, desks, chairs, clubhouse furniture or TVs, package lockers, like places where your tenants have their Amazon packages, playground equipment, and trash compactors. All right, to be clear, that was all personal property that can be depreciated over 5 to 7 years. And then there are those land improvements, those 15-year assets also eligible for bonus depreciation. Sidewalks, fencing, landscaping and irrigation, parking lots and striping, outdoor lighting, retaining walls, and signage. Okay, again, those are the land improvements, the 15-year items. Things that are not eligible for bonus depreciation are the building structure itself, like I mentioned. That includes the roof, framing, drywall, foundations, and also things like elevators, structural plumbing and wiring, and HVAC systems that serve the whole structure. Okay, all that stuff falls in the category of regular 27.5-year depreciation. All right, so what is the 100% bonus depreciation effect? All right, well, your eligible amount in our example is $150K of personal property plus $50K of land improvements. That's $200K that you can deduct all in 1 year, rather than having to spread it over 5 and 7 and 15 years, but all in year 1 of you owning the property. That's $200K. And again, the remaining $800K structure is depreciated over 27.5 years. That works out to about $29K a year. This is where it gets exciting. Here we go. So your total year 1 depreciation, the year that you bought this asset and put it into service, with your bonus depreciation items adding up to $200K and your regular building depreciation at about $29K, your total year 1 deduction is about $229,000. Wow! Before I break that down some more and tell you about how it really helps you, let's just be really clear. How did you really get to the $200K of bonus depreciation? All right, let's say the cost segregation study allocated $80K to appliances, flooring, and fixtures. Remember, they are the 5 to 7 year items. Another $70K to common area furniture and office equipment. That was the 7-year stuff. All right, so there's $150K of personal property, and then another $50K to that outdoor stuff, the depreciable items known as land improvements, like the parking, landscaping, and fencing, those 15-year items. That's how we got to $200K, all bonus depreciation eligible, all fully deductible in year 1 under the 100% bonus depreciation rules. All right, so here it is. Here's the takeaway. You have front-loaded an extra $200K of deductions in year 1, and you have greatly reduced your taxable income. This is the outcome. This is the result. You just reduced it by $229K between the bonus depreciation and the regular depreciation. All right, so what is the effect of you reducing your taxable income by $229K in 1 year? Well, if you're in the, say, 32% tax bracket, you keep an extra $73,000 in your pocket. That's $73,000 that you would have had to send to the IRS for the next tax year, but no, you don't. And that is the power of bonus depreciation. That's how it works, Ed. And for all of you that asked about it, I know it's not that simple, and there were a lot of numbers flying around there. It got a little heavy, but that's a complete breakdown. That's why so many people are excited about the return of 100% bonus depreciation as laid out in law with the One Big Beautiful Bill Act. As you can see, it's going to help higher income people more than anyone. If you'd like to get this going and connect with GRE's recommended cost segregation engineer, or just check and see if it's worth paying several $1,000s for the cost segregation study, we can help you with that. In fact, you might remember that I interviewed him on the show last year, and we will make that introduction for you and help ensure that you have a successful cost seg and bonus depreciation experience, regardless of the size of your portfolio. Even if you don't own million-dollar apartment buildings, you don't have to have a huge income for this to benefit you. It just benefits those people the most. Well, you can set up a time to chat with us about that completely free of charge at greinvestmentcoach.com. I think you know that's where you can also get a completely free strategy session about growing your overall real estate investment portfolio. You might as well do that at the same time at greinvestmentcoach.com. More next. I'm Keith Weinhold. You're listening to Get Rich Education. The same place where I get my own mortgage loans is where you can get yours. Ridge Lending Group, NMLS 42056. They provided our listeners with more loans than anyone because they specialize in income properties. They help you build a long-term plan for growing your real estate empire with leverage. Start your pre-qual and even chat with President Chaley Ridge personally. While it's on your mind, start at ridgelendinggroup.com. That's ridgelendinggroup.com. You know what's crazy? Your bank is getting rich off of you. The average savings account pays less than 1%. It's like laughable. Meanwhile, if your money isn't making at least 4%, you're losing to inflation. That's why I started putting my own money into the FFI Liquidity Fund. It's super simple. Your cash can pull in up to 8% returns and it compounds. It's not some high-risk gamble like digital or AI stock trading. It's pretty low risk because they've got a 10-plus year track record of paying investors on time, in full, every time. I mean, I wouldn't be talking about it if I wasn't invested myself. You can invest as little as $25K and you keep earning until you decide you want your money back. No weird lockups or anything like that. So if you're like me and tired of your liquid funds just sitting there doing nothing, check it out. Text FAMILY to 66866 to learn about Freedom Family Investments Liquidity Fund. Again, text FAMILY to 66866.
This is Rich Dad Sales Advisor Blair Singer. Listen to Get Rich Education with Keith Weinhold, and above all, don't quit your daydream.
Welcome back to Get Rich Education. I'm your host, Keith Weinhold. If you have a listener question that you'd like to have answered on air, get a hold of us at getricheducation.com/contact. That's where you can either leave a voicemail or write in to us. I'd like to tell you that frequent guests that we have here on the show, all from the Rich Dad School, if you will, are going to be speaking in person at Penn State University in just a few weeks here. It is on the 29th of this month. Yes, an event you can attend in person. It's going to be Robert Kiyosaki, Garrett Sutton, and his son Ted Sutton, and Tom Wheelwright. The four of them speaking live and in person, sponsored by Penn State's Borelli Institute for Real Estate Studies. The event is named Rich Dad Revealed, Real Estate, Wealth, and Wisdom. If that's of interest, look it up and check it out. From listening to the show and being a savvy investor that's inflation aware, you know that the mission is to turn a really fake asset, a conjured into existence asset like a dollar, convert that into a real asset. Here is some astonishing clarity on why that's the mission, and this could leave you flabbergasted. Since 1980, the United States has 1.5 times more homes, 2 times more gold today, and 42 times more dollars today. My gosh, that is almost laugh out loud material here. Yes, since 1980, the year that Jimmy Carter was president and Star Wars The Empire Strikes Back was the top grossing movie, the U.S. has 56% more residential housing units today. So basically, since the year that Darth Vader told Luke Skywalker, "I am your father," there are about 1.5 times more homes, twice as much gold mined and brought into existence, and 42 times more dollars created out of thin air. For the future, all of these trends are expected to continue at roughly the same trajectory and proportion to each other. Now, there's a reason that people use precious metals to measure inflation. It makes a particularly good measuring stick because commodities like gold, silver, platinum, palladium, rhodium, and copper, they don't change over time. unlike a car or a bottle of soda, these items are on the periodic table of the elements. An ounce of gold 1,000 years ago is exactly the same as an ounce of gold today. That's why commodities like this are such good long-term inflation measuring sticks. And then there's Bitcoin, something that didn't even exist until 2009. There will only ever be 21 million of them in existence. And 95% of Bitcoins, about 20 million, have already been mined into existence. So yes, only 5% more will be issued, and it's going to take about the next 100 years to do that. If Bitcoins were the size of a quarter, all 21 million of them could fit inside a single shipping container. There's some fixed supply scarcity. Let's listen to this. It's about 30 seconds long, and it's called All There Will Ever Be.
Every day, the Fed prints an average of $465 million. That's 26,000 shipping containers a year, created out of thin air. Maybe that's why the dollar loses value over time. But there's one thing they can never print more of: Bitcoin. At the size of a quarter, this is all there will ever be. Shouldn't a store of value hold its value?
That's actually a Coinbase video advertisement that we just listened to the audio of there together. Yes, what they show at the end is a shipping container where if Bitcoin were the size of a quarter, all of them that will ever exist would fit in one shipping container. And like it said, every single year, on average, the Fed prints enough dollars to fill 26,000 shipping containers. Just staggering. There are so many dollars now, I'm thinking of replacing my insulation with stacks of ones. Same R value, better liquidity. Pretty soon, we won't count dollars anymore. We'll just weigh them. Welcome to the Zimbabwe Starter Kit. We have gone from sound money to clown money. That's another way to think of it. Oh, they say money doesn't grow on trees. That's true. It grows in spreadsheets now, though. One keystroke at the Fed, and poof, there's another trillion just like that. Just hit the control plus the print key. That's all it takes. All right, well, let's take a look and see how this manifests in your life as a consumer and as a real estate investor and as a worker. Since January of 2020 to today, a $100,000 salary has the same buying power as $125K today. Yes, over just the last 5 years, the dollar has lost 25% of its value. And now I'm talking in terms of the CPI here, the Consumer Price Index. So, of course, all these figures I'm using could really be higher. Like we say, therefore, these figures are only the inflation rate that the government is willing to admit to. How does this break down by region? So yes, we have 25% national inflation over 5 years, but different regions have different rates of inflation, including the region where you are. And this is due to reasons like climate and the composition of industries and even cultural preferences. For example, a southern climate with a lot of air conditioner use spends more on electricity. So if electricity costs are high there, then that region's inflation rate could be higher than that of a northern climate. A place like Omaha, Nebraska is proximate to a lot of agricultural crops and beef. But a place far from where those items are sourced could be more sensitive to changes in beef prices or less sensitive. So over the past 5 years, here's how much annual inflation in these select cities have experienced, again, per the CPI. From lowest to highest, San Francisco is just 3.3% per year. So in San Fran, your $100K salary in 2020 would need to be almost $118K today just to maintain purchasing power. New York City, 3.9% annual inflation over the last 5 years. Chicago, 4.2%. Philly, 4.3%. Seattle is at 4.8%. Dallas-Fort Worth, 4.9%. St. Louis, 5%. Atlanta 5.1, Miami 5.4. We're really getting up there now. Phoenix 5.9, San Diego 6.1, and the major city with the highest inflation rate over the past 5 years is Tampa, Florida, at 6.4% annually. Tampa's had some of the highest real estate appreciation over the past 5 years as well. So this means that a $100K salary 5 years ago in Tampa would have to be $128K today just to maintain purchasing power due to its 28% cumulative inflation the past 5 years. But that's the CPI. The real figure could be 40% plus in Tampa. All right, now this information is useful because even if you believe that the CPI is understated, which most everyone that's looked at it does, as long as the methodology is consistent, you can see the regional variation here. Again, San Francisco was lowest at 3.3, Tampa about double at 6.4%. The ever-present force of inflation, it's merely surreptitious until you have a big wave of it peaking in 2022 that everyone noticed. Let's look at how it's contributed to the real estate price run-up since 2020. All right, so in the first quarter of this century, you might find this unbelievable in itself. In the year 2000, the median-priced Florida home was $195K. I mean, that's the median price, and then the investor sweet spot is usually lower than that. It might have been $130K in Florida in the year 2000. So again, $195K in Florida for the median home price as recently as 2000. Today, it is $412K. Gosh, almost as surprising. In Texas, it was just $153K in 2000, and it's $338K now. I mean, don't these prices like $153K in Texas make it seem like the price for a doghouse already? New York, $276K up to $576K. Also, from the year 2000 to today, Washington, D.C., $293K up to $643K. Colorado, $377 up to $582K. Florida, more than doubling, $393 up to $833. And Washington State, also more than doubling, $313K up to $630K. My gosh, price increases like this, they're a function of both monetary inflation and depreciation, and it's really a chief reason that the Fed has not cut interest rates this year. It's because the memory of soaring inflation is still much too recent. To review what you've learned on this week's episode, changes to realtor fees have made less industry impact than many expected. The smaller your down payment, the more powerful your leverage fulcrum. The return of 100% bonus depreciation has many investors and even non-investors interested in adding income property to their portfolio, and staggering inflation is a motivator for adding real assets to your life. Hey, if you would, I would love it, and it would mean the world to me if you found this episode valuable enough that you would share it with a friend. I put a lot of thought into it, just like I do every single week. Friends are probably going to find explanations about realtor fees and bonus depreciation highly helpful this week. You can either share the episode by word of mouth or take a screenshot of this episode and put it on your social media. You might want to write out that it's Get Rich Education in your social post because it only shows GRE on our podcast cover image in some views. Thanks for telling a friend about the show. Until next week, I'm your host, Keith Weinhold. Don't quit your daydream.
Nothing on this show should be considered specific, personal, or professional advice. Please consult an appropriate tax, legal, real estate, financial, or business professional for individualized advice. Opinions of guests are their own. Information is not guaranteed. All investment strategies have the potential for profit or loss. The host is operating on behalf of Get Rich Education, LLC exclusively.
Whenever you want the best written real estate and finance info, oh, geez, today's experience limits your free articles access, and it's got paywalls and pop-ups and push notifications and cookies disclaimers. It's not so great. So then it's vital to place nice, clean, free content into your hands that adds no hype value to your life. That's why this is the golden age of quality newsletters, and I write every word of ours myself. It's got a dash of humor, and it's to the point because even the word abbreviation is too long. My letter usually takes less than 3 minutes to read, and when you start the letter, you'll also get my 1-hour fast real estate video course. It's all completely free. It's called the Don't Quit Your Daydream Letter. It wires your mind for wealth, and it couldn't be easier for you to get it right now. Just text GRE to 66866. While it's on your mind, take a moment to do it right now. Text GRE to 66866. The preceding program was brought to you by your home for wealth building, GetRichEducation.com.